Cool. So, can you all hear me? Just give me a thumbs up or yes, sir, if you can hear me. Just want to know that you can hear me loud and clearly. Thank you, Kia. Thank you very much. Cool. Awesome stuff. So, like I said earlier, for those of you who were in already at the time, today is just a light session. Thank you, Manzini. Thank you, thank you. Thank you, Abigail, as well. Awesome stuff. So I want us to turn to exercise 4.3. I want us to do 4.3 today. Exercise 4.3. Exercise 4.3. And guys, here's the deal that I have with you today. I just wanted it to be an interactive session. So we will end class as fast or as soon as you get us through the exercises, okay? So the quicker you respond, the quicker I will let you go. We're just doing exercise 4.3 and we're doing exercise 4.8. 4.8 is like 4.2 of yesterday. It's just a theory question, so we're just going to be discussing that. Okay. So the sooner we get through 4.3, the sooner I can let you guys go. But that said, let's get into the question. Let's see what's happening over there. Under required, it says prepare the post-adjustment trial balance on 31 August 2007. Draft the statement of financial position as at 31 August 2007. Prepare the statement of profit or loss and other comprehensive income in the year ended 31 August 2007. Okay. Right. What else do they say there? Prepare the statement of changes in equity for the year ended 31 August 2007. Prepare the notes to the financial statements. Okay, cool. As always, we'll be just dealing with the adjustments. And then, guys, remember, I need you to go and master those statements. All right? The structures of them, at least. So that you guys can obviously then not only be able to do the necessary adjustments, but also know how they impact the relevant statements. Okay, so I'm just quickly drawing our financial year. So it's 31 August over here. And this is 2007. Sorry, excuse me. Let's see. Yeah, 2007. So the financial year will begin 1 September 2006. So this is the period that we are interested in. Okay, cool. Awesome stuff. So after reading the required, let's see what else they give us there. Okay. Let's see what else they give us there. They say the following pre-adjustment trial balance appears in the books, all right, at the end of the second financial year. Pre-adjustment trial balance on 31 August 2007. Okay. So we have all the amounts there. Can you see this is actually a much bigger pre-adjustment trial balance? Okay, cool, no problem. All right. Then they say adjustments at year end. Okay. According to a physical stock take, the following was on hand on 31 August. So we have trading inventory 21,000. Okay. So that's what we saw when we did our stock take. But when we look at trading inventory in the pre-adjustment trial balance, we see there 21,370. So what do we need to do? What adjustment do we need to make in connection with trading inventory? For that first part there, prepare the post-adjustment trial balance. That's what we want to work with. They didn't ask us to do the general journal. They've asked us to do the post-adjustment trial balance. Can you see they also didn't ask us to do the general ledger as well? Okay. So this unit 4 can come at you in so many different angles. That's why it's important to know all your statements. Okay, but guys, so what do we need to do with trading inventory? A stock take showed us that we have 21,000. Okay, but in our books we're supposed to have 370. So thank you very much, Abigail. We need to subtract 370. Okay, so we go to our trial balance. We look for trading inventory. Okay. We look for trading inventory. Okay, and there we say, okay, we know it's 21,370, but a stock take showed us it was 21,000. So we're deducting the 370 to make sure that we have 21,000 to match what we actually have on hand. Okay, so we've dealt with that one. Then we go to the next one. It says postage and stationery. Okay, postage and stationery on hand is 750. Interesting. So what do we do here, guys? We have postage and stationery, that is 750 on hand. Okay, on hand. So basically what they're saying, we went during the course of the year, we were buying postage and stationery, which we know is an expense. All right, it's a consumable. But guess what? We get to the end of the financial year and we actually still have some postage and stationery to the value of 750. What do we do with this 750? What must happen? Remember we said at the end of the financial year, our consumables, all right, then become what? What do they then become? What did I say yesterday? What type of adjustment do we need to make here? Come, guys. You're also allowed to switch on your mic and engage. I don't mind. You can ask me questions to help you arrive at the answer. I don't mind. What do we need to do in terms of postage and stationery? We need to subtract 750. It is an accrued expense, I think. Thank you very much for thinking, Tsepang. We appreciate that. So you do need to subtract 750 from the expense of postage and stationery. So let's do that. That's the first bit. You are 100% correct. Okay, where are we? Postage, where are you? So in the pre-adjustment trial balance, we see postage and stationery was 4,750, okay? But now we know that we have some of this on hand which was not used, so we're subtracting that. So that's going to leave us with 4,000. Okay. All right. Now over here, the next thing we need to do is, so it's not an accrued expense, but it is consumable stores on hand. So here we put 750 because maybe we'll have some more. Okay, I see we've already plugged that in there, but let's just see. Maybe we might have more. If we don't, it's okay. So that's how we treat it. Okay, consumable stores on hand. These are current assets we know we're going to sell. We can sell them if we were to liquidate. Okay, right. So thank you so much for that, Tsepang. Yes, yes, 100%. Cool. So let's proceed to the next one. The next one we see here, it says depreciation must be written off on vehicles at 25% per annum according to the reducing balance method. Okay, I see some people have just joined us. Welcome, welcome, welcome. We are doing activity or question 4.3. Right. No vehicles were bought or sold during the financial year. Okay, so we need to do depreciation, okay, on vehicles. Okay, fortunately, nothing was bought or sold. So this is just simply a depreciation calculation that we need to do. So I think I'm just going to use this timeline over here. Okay, well, we know it's a year. Okay, nothing has, again, we said we haven't bought or sold anything. And we're on the reducing balance method. So we need to look for the value of vehicles, all right, which we know we can see there now post pre-adjustment trial balance is 240,000. Then we want to minus the accumulated depreciation, which is 60,000, okay, which then gives us a carrying value, okay, of 180,000. Okay, so now we have our carrying value. Now we can apply our rate of depreciation, which we know is 0.25%, or should I say 25%? Okay. So then what is the depreciation that we have on these vehicles? Somebody tell me. Somebody give me the answer in the chat. Somebody. We're saying 180,000 times 25%, the carrying value, since it's on the reducing balance method. All right. Thank you, Manzini. Thank you, Abigail. Thank you, Tsepang. 45,000. I will take your guys' word for it. Right. 45,000. Okay, thank you very much, guys. Cool. So we look for depreciation. Okay. Depreciation, where are you? Oh, here we are. Just in case we might have another depreciation calculation. Okay, so we put the 45,000 in there. Then we know whenever we account for depreciation, what's the other account? What's the contra account? Whenever we are recording depreciation, we need to also record what? Accumulated depreciation. Thank you very much, Tsepang. Yes, that is 100% correct. Let's see, where is our accumulated depreciation? And there we have it on vehicles. Again, I'm just going to put this in brackets for now. 45,000. Cool. All right. Cool. So let's proceed. We are on a roll. Okay, the following adjustments must be made to enforce the accrual concept. Okay, wages and salaries payable. Okay, so you guys tell me, wages and salaries payable, 8,000. Okay, we know that we need to make an adjustment with wages and salaries, but what else needs to happen? Okay, what do we need to do firstly to wages and salaries? Okay, since this is payable, what are they trying to tell us? What needs to happen to wages? We need to add 8,000. Thank you very much. That is 100% correct. We need to add. It's payable. It's owed. Okay. It's due to our staff or one of our employees. Okay. It still needs to be paid. Yes, 100%. So we know that wages and salaries is going to go up. Okay. What else? What other account is affected? What other account is affected? Is it an accrued income? Is it a prepaid expense? Is it income received in advance? What is this thing? What is the other account that is affected? Somebody tell me. Okay, whilst you guys figure that out, let's adjust wages and salaries. Where's our wages and salaries? It's an expense. So our old oh, so now I see what I needed to do here. Accumulated depreciation was supposed to do it like this. 60,000 plus the 45,000 we just calculated. Okay, but let's leave that there for now. We will come back. Wages and salaries. We are saying our wages and salaries in the pre-adjustment trial balance was 21,660. Okay, and then we're saying plus 8,000. Okay, which would then take us to how much? 8,000 there. That's going to be 29,660. Okay, so we've dealt with that one. What's the other account that's affected, guys? Accrued expense. Thank you, thank you, thank you, thank you. Thank you, Manzini. Thank you, Tsepang. Okay. Let's see here. Where's our accrued expense? So we're going to say 8,000 over there and plus sign. Okay, happiness. Then telephone prepaid for September 2007, 1,800. Ooh, we have prepaid for September. Remember, what's our financial year? Our financial year ends in August. Okay, so we've gone on to pay for September. Okay, just gonna put SEP there. This is outside our financial period. So what must happen with this prepaid telephone? What must happen with this prepaid telephone? What do we need to do? We add 1,000 and the other account is prepaid expense. We add. Are you sure we add? Let's think about this. Come now, guys. And this is open to everyone. September is outside of our financial year. Okay, we only want to record stuff that's in our financial year. Yes, you are lying, my friend. You are lying. And indeed, you are right as well. We minus. Okay, so we need to actually minus that. But you are also right in saying it is a prepaid expense. So we can start here. We can start here and say, okay, prepaid expenses, 1,800. Okay. And then we're saying, where is this? Telephone, where are you? Telephone. The prepaid, the telephone balance in the pre-adjustment trial balance is 38,000. I heard something in the chat. I'll be with you now. All right. And then we're saying minus the 1,000 because we've paid it, but it's outside of our financial period. We don't want anything outside of that. Okay. What is the answer there? Can someone quickly calculate 38,000? And 40 minus 1,800 should be 37,000 something. Okay. Oh, 36. Okay. Thank you very much for that. 36,000. I'll just copy and paste. Right. Okay. Right. So let's make that a little bit neat. Okay, cool. So we've dealt with that. Okay, then we go to the next one. Rent received in advance, 2,000. Rent received in advance. Okay. So again, since we've received in advance, it means that it is outside. Can you see sometimes they won't even communicate the dates to you. They're saying we've received rent in advance. So we've received it for a time frame outside of our financial year. Okay, we haven't yet provided the shelter, but guess what? The person has already paid. So here again, we're going to say rent income, 26,000. That's what we have in the pre-adjustment trial balance. Then minus this 2,000. Okay, that's obviously going to give you 24,000. So our rent income should actually be 24,000 for this financial year. Okay, and then we know this is income received in advance. So we're going to come here and say, okay, 2,000 for income received in advance. Okay, then the next one, accrued interest on fixed deposit. Accrued interest on fixed deposit. Okay, so basically what they're telling you here is we are owed interest. All right, it is due to us on fixed deposit. Okay, because it's on fixed deposit. Fixed deposit means we invested in something. Okay, right. So we're saying, okay, what was our interest on fixed deposit? 3,920. Okay, and then we're saying plus this accrued interest of how much? 210. Okay. That should give you 4,130. Okay, we dealt with that one, but now also this is accrued income, so we need to put that in there. 210. Okay, right. 210. Okay, then the last adjustment that they're asking us to do there is they say create an allowance for credit losses to the amount of 695 Rand 50 cents. So how do we do that, guys? Somebody tell me. How do we create an allowance for credit losses? Remember we spoke about this in the slides when we were introducing Unit 4? How do we create an allowance for credit losses? What must happen? Which two accounts are we going to use to create an allowance for credit losses? Come, guys. We've almost finished the most challenging part of this question, which is to actually do the adjustments. How do we create? Okay, there we go. Allowances for credit losses, yes, and allowances for credit losses adjustments or adjustment. 100%, those are the two accounts that we use. And just as we're on that subject, which one of these is a negative asset and which one is an expense account? Which one is an expense account and which one is a negative asset account? Come, guys, open to the floor. Open to all of us. Which one of those is a expense and which one is a negative asset? Okay, allowance for credit losses is a negative asset. Yes, adjustment is an expense. Okay, 100%. Thank you, Abigail. Thank you, Tapang. 100%. Okay, so let's quickly record this now. Okay, let's quickly record this right here. So we go to allowance for credit losses, as you guys highlighted. That is the negative asset. Okay, and there we've already plugged it in. Can you see? 695.50 cents, right? Then we need to go to the expense under the nominal account section, and we look for allowance for credit losses adjustment, and look what we've done there. We've debited that. Okay, can you see that we debited the expense and we credited the negative asset? Okay, and we are done. Okay, now we just need to fill in this information. So this we said is 8,000. Hey guys, you cannot, if you don't know that consumable stores on hand is a current asset, okay, you're not going to correctly debit it when it's increasing. If you don't know that accrued expenses is a current liability, okay, you're not going to credit it like we have here, okay? Just write it here, CL, so you guys can see that that's a current, this is a current asset, CA. Okay, so you all have this reference point when you watch it on YouTube, right? Prepaid expense is a current asset. Okay, we're plugging in there 1,800. Okay, then income received in advance. What is that? Somebody tell me in the chat. What is income received in advance? Come. What is income received in advance? Okay, right. Yeah, right. Just in the interest of time. Okay, somebody said expense. Nope. Is a current liability. It is a current liability. Okay, awesome stuff. Okay, thank you for attempting it. Thank you, Luazi. Thank you, Abigail. Thank you, Tsepang. Right. So that's a current liability. All right, then accrued income. All right, that's a current asset. It's money that's owed to us. Okay. Now I'm even forgetting to put in the amount. Okay, so you guys, you need to know these things so that you can treat these things properly. And then here we said allowance for credit losses is a negative asset. Negative asset. Okay. All right. Okay, cool. So I forgot to do something here. Remember when we adjusted trading inventory, we also needed to adjust cost of sales. Okay, remember whenever there's a discrepancy in trading inventory, we also need to add that amount to cost of sales because it's like a loss to us. So here we know the cost of sales amount is 4,088. Oh, so sorry, 488,000. So then we're adding that 370. Okay, another way to think of this is that there's always at least two accounts that are affected by every transaction. Here we only changed trading inventory. We needed to change another one. Okay, so we're debiting that. Okay, we recorded that one, recorded that one, recorded that one. Okay, so I don't think we recorded depreciation, so this is going to be 105. 105,000. Then depreciation here, we don't have any other depreciation, or do we? Let's see. Yeah, I don't see any other depreciation in the nominal account section in our pre-adjustment trial balance, so we'll just put the 45,000 in there. Okay. Right, and that's your post-closing trial balance. That's your post-closing trial balance, right? So what I did here is I just threw in the rest of them, because once you have your adjustments correct, it's now just about filling in the right information in the right places in the other statements. So we drafted the statement of financial position there. There you have it. It was a copy and paste job on my side. Okay. So what would then change obviously is your trade and other payables because of those liabilities that we have, such as income received in advance, accrued expense, okay? Then also your trade and other receivables, your trading inventory was changed, okay? We also know that we have prepaid expense, all right, which is a current asset, so we need to throw that in there. Obviously, the calculation will happen in the note, but then that's just the grand total. Okay. Then here in the statement of financial position, all right, we know our revenue has decreased. Where is this 18,000 coming from? Sales returns. Did we have a sales returns transaction? Oh, just generally sales returns. Oh, thank you so much, Japan. Thank you so much for that. You're 100% right. Okay, all right, so that's that. Cost of sales, you can see the adjustment there. Rent income, you can see the adjustment there. Interest income, the adjustment over there. We actually calculated this when we adjusted our rent income. Okay, and then you got your telephone, all these adjustments. Can you see? Interest expense, okay. There was no adjustment there, by the way. Then you obviously have your statement of changes in equity. There, your capital balance as at 1 September. Okay. And then obviously we add the loss, or we subtract the loss from the capital balance, and we subtract drawings, and we actually have less capital. This is what I was talking about when we met in person, to say if you make a loss, obviously you're deducting it from your capital, so your capital is getting reduced. Okay, and then this is the notes, guys. This is the notes. Okay, interest on investment, we're adding that fixed deposit accrued to us, but we haven't received yet. Okay, so here are all your notes. Can you see property, plant, and equipment? We played around with this when I last saw you. Okay, all right, and so that's that. Also, so I think in terms of structures, this is the bit that one needs to really put some effort and time into. Sometimes they can ask you a question on trade and other receivables, the structure of this just alone. Okay. All right. So be familiar with your notes. Okay. Trade and other receivables, trade and other payables. Make sure you know your structures there. Sometimes that can be a question in and of itself. Right. So are there any questions in relation to 4.3? So 4.3 was just a nice light exercise, at least light in terms of they didn't ask too many questions. And they didn't ask it typically how they would in terms of do the general ledger or do the general journal, but they've asked you to do it in what you call it, in the trial balance. You must basically do the post adjustment trial balance. So a nice light exercise there, but you have to know what accounts are affected by your respective adjustments. Okay. So I'm guessing everybody is good in that department. We're good with question 4.3. So we can proceed to 4.8. So let's just quickly do that. Okay. All right. So with 4.8, and I want you guys to go in your textbooks. My textbook, at least, I think it's 2019. Let's see. Do they write what year it is? Okay, they don't. But if you check your answers for question 4.8, which is what we're going to go into, basically all that they're asking there is 4 qualitative characteristics of a well-prepared set of financial statements. Okay, you guys know this because in accounting 1A they ask about this and they love to ask this. So I know you saw them ask this either in an assignment or one of your tests or in the exam itself. Okay, so the 4 characteristics: understandability, relevance, faithful representation, and comparability. Okay, so under understandability, they're saying the following: the financial statements must be understandable to the user thereof. Okay, however, it is implicitly assumed that the user has a reasonable knowledge of accounting and a willingness to study the financial information diligently and comprehensively. Okay, relevance. When deciding what is relevant, one must consider the user's needs in decision making as well as the materiality of the items. Materiality is a term that is very important for every prospective accountant to understand. Okay, it basically means that all material items or items of significance must be recorded by the accountant. An item can be an actual transaction or the choice of a value to be assigned to a transaction. Okay, I don't need to go into all of that. But basically, important information must be included. All right? Must be included. Everything that is material must be included in the financial statements so that the user or those looking at the statements can make good decisions. Okay? Then faithful representation. In order for financial statements to be considered faithfully represented, they should, to the maximum extent possible, be free from error, complete and natural. They should be fair representation of financial performance and position. Lastly, they should represent the substance of each transaction or event and not just the legal form. Cool. Then comparability. Right. Financial statements must be comparable from one year to the next. Therefore, accounting policies must be consistently applied. This means that similar transactions should be treated in a similar fashion and in the same way they were treated in the previous year. In order for this to be achieved, accounting principles must be consistent. Right, ladies and gentlemen, that obviously was more of a recap than anything, but I thought it relevant for us to go over that. Why? Because now we're dealing with financial statements, okay? So now you can see why it is important for us to obviously follow the structures that IFRS has recommended to us, okay? So that anybody with a reasonable accounting background can understand what it is that we're actually doing. So that our users, can see material things and obviously make decisions. In other words, so that the financial statements are relevant for them. Faithful representation, okay? And comparability. Okay. So anyway, ladies and gentlemen, we are right on the dot in terms of our first session. Okay. Right. I don't have anything more that I wanted us to actually get through for today. Okay. I want you guys to take the time to go and do your assignment. And obviously, if you have some time, go and do your ICE task, but first finish off your assignment. Make sure you handle that. Okay. Otherwise, that is it from my side.